Okay, welcome back to another episode of the Backholder Pod. So I think specifically today, it's the age-old debate again about whether an investor should engage in some level of active investing in his current investing journey thus far. So I think just recently, particularly so in the Singapore influencer space, I think two very notable influencers. So on one camp, you have the camp from Mr. Lu from 1M65, where he talks about just passively investing, staying invested, and just investing using via a broad-based market instrument like the S&P 500 QQQ. And even recently, he starts talking about getting internationally diversified. I think he did say that he's considering. He hasn't really pivoted over yet, but fundamentally, his structure is looking at it via a CPF safety net and then going into the SPY and then going into QQQ for a much more riskier exposure. On the flip side, you have many other investors that are in the camp where you can engage in some level of active investing. And I think AK71 specifically focuses on dividend investing or hoping to get or derive passive income from his portfolio. So Mr. Lu, on one hand, the passive investing camp says that, it requires a great deal amount of ability for you to look at individual stock counters, able to pick good stocks and to ride it out even through market up and down cycles. While AK, on the other hand, says that income investing for himself over the last 20, 30 years have worked. And there are testaments from many of his readers that they have worked and they've done very, very well, in fact. And I think many of them probably are semi-retired or retired already in their own means because they have been accumulating good shares and just focus on income and stuff like that. So I think I just wanted to open to the floor and to see what are the perspective of the different viewpoints here. And I believe that actually all of us do engage in some level of active investing ourselves and picking good stocks, and hopefully all of your good stocks and we can retire earlier. But anyway, I think just to open to the floor, Bunty, what's your perspective on these two camps?
I think for investing, it's not just two camps, right? There are, chicken Alibaba camps, and then there's Tesla, Eric camps. I myself have my own camp, but not like a super opinionated one. But comes to like just comparing these two, right? Like if I just look at my portfolio, of course I'm more aligned with Mr. Lu, because I'm more steered towards like US market, Western markets, instead of like local Singapore markets. So more aligned on that. And I think it's not really a debate between two of them. Like, it's just like very different approach. It's just that each of them pointing out what's the weakness of the other approach. Say, for example, people ask Mr. Lu, I want to do like dividend investing. What do you think? He will of course say, okay, if you don't know how to pick stocks, then stay away from investing for incomes. Because for companies that keep on paying dividends outright, they may not have enough money to do their own, like investment to their own companies. So these are some of the pitfall or some of the things to watch out, that if you don't know like individual stock analysis, better to stay away. Yeah.
Rather than not say it's not a debate, actually it is a debate, because one side I think has been, actually I think for AK himself, he hasn't really been saying much about passively investing. And if you say you want to be passively invested, then I think so be it. He's not here to convince you otherwise. But I think it's Mr. Lu, on the other hand, have constantly or repeatedly say that dividend strategy is a very dangerous strategy. Looking into getting income from your stocks is also very, very, it's a bad way to look at things, because like Bunty has suggested or point out, the fundamental idea of having dividends being paid out means that the company has some level of retained profits and earnings, and they don't retain it on their balance sheet. They don't look at it in terms of an acquisition strategy or growth strategy. They just apportion a large part of their money out back to shareholders to benefit you in a way in terms of your dividends and stuff. So I can kind of understand where Lu is coming from, in a way where if you don't have this kind of dry powder, or if you don't retain some amount of cash on the balance sheet, when hard times comes, you don't have the ability to weather through the storm. So that's basically what his general thesis is, and why dividend strategy is bad. Hey guys, have you heard?
So what, your stock 10x?
Not yet lah, but Webull Fund Any Amount promo is back.
Wow, any amount?
Any amount. You fund $1 also can. Then you'll get free gifts.
So if you haven't signed up to Weibo yet, you can sign up using the links down below.
So back to maybe Eric on the idea of dividend investing. Do you find it dangerous? And what's your process to look at some of these dividend stocks?
I think there's two levels of investing in dividend, like specifically REITs. I think there's AK himself, right? If I'm not wrong, I think he used to be a huge investor in Ames REIT, which is not a blue chip REIT. And I think some of his investment also, there's another one, China one, Sizen REIT or something like that. Yeah, so he invests in those kind of REITs that give slightly higher dividend yield, maybe 7-8%, some even 10%. So I think he does actively research his REITs and go for those that have like he feels have better risk to reward ratio. Yeah, so he doesn't blindly just go for the highest yield, nor does he go for those blue chip REITs, which is the strategy that I'm doing lah. Like previously, because I'm not really that pro in picking which REIT is the best lah. Give me the best return. So I basically just go for the brand names of like those like a bit steady one like CapitaLand, what else? Ascenders, Maple
Parkway
Tree,
Life.
yeah, Frasers. Parkway Life I didn't buy because the yield was too low. I really couldn't. My finger couldn't click the buy button. Cannot make it. Yeah. So I went for the blue chip one. I think so far I got to say, right, when you invest in REITs, right, you really need to look at the macro environment. Yeah. Like when the interest is low at its all-time lows, it is pretty good. The going is pretty good. Like you can get like 5-6% easy, don't have to think much. But when the interest start trending up so fast, I think a lot of the REITs suffered, not just the blue chip. But I guess the blue chip ones, they are holding up okay, but the yield have gone down in absolute terms. I mean, now if you compare to their share price, it's still 5-6%, but in absolute amount, it has gone down. So I would say, like, if you invest in dividend stocks, you do need like if you want exceptional returns, like better than S&P, you probably really need to pick the REITs and the timing, right? Like I think AK, when he went into Ames, it was when he was doing the, who's the person? George Wong or something like that. I think the person that took over and turn it around when it was in distress. So he bought it in when it was like doing very badly, and then the REIT turned around, managed to be safe lah. Yeah, I think the previous name was called MacArthur or something, the REIT. So they changed the name, got a new CEO to come, save the REIT, and then pump in some liquidity, and then they went back on track lah. Then he benefited quite a lot from it. I think his yield was easily in excess of 10 to 15% easily. I'm not sure whether is it like 20% or more, but easily above 10% per annum. Yeah,
That's based on from his cost price, right?
Yeah. So the timing which you get into this kind of quote slightly distressed REITs, right, is important. He also pick out some examples where it's distressed for a good reason and he didn't go into it. Like I don't want to say those kind of I think Hong Kong related REITs he rightly didn't go into those. So I think up till today it's still bad. Didn't turn around for most of those REITs.
What's Kevin's perspective on this?
Let me share screen. 20 million. For AK, I believe he's earning like 200K in dividends last year. He gave a rough estimate, it's about $3 million lah. So it's 6% yield, which is actually quite normal in REITs and in dividend stocks lah. So for him, I think he got in at the right time. Like what Eric said, you have for REITs to get a high return, you have to get in at the right time. AK is the first guy The one that I was following in the past was this girl, lady you can be free. She grew 100k Sing dollar to $1 million in 7 years. This kind of return, you can only get it from Tesla, Nvidia, and not from dividend stocks. So for both AK and this lady you can be free, I believe they got in right at the right time around 2009. Yeah, luck. I think for them, luck is a very, very big factor. But for most of us, right, dividend stocks, you will only get like 4 to 6% kind of returns, which is what you normally get. But so for what Mr. Lu said, he said dividend stock is dangerous because they are paying out the money that they have earned. But I would say that is because he was using the wrong example. This is for Mapletree Logistics. 10 years ago, they were giving 0.06 dividend per unit. Fast forward 10 years, it's like increased by 50% kind of payout. So if you have the patience, right, dividend stock is very low payout at the start. Then the longer you hold, right, the higher the payout. In fact, I think it will give higher returns than compared to growth stocks if you manage to hold it over 30, 40 years, that kind of runway. This for CapitaLand also. 0.137 now is not a lot, 10% increase. Still a lot, but still a lot. This for DBS. DBS increased quite a lot, 0.6 to 1.9 is almost 3 times the initial dividend. So how I would usually find this, a blog by Ivan, is another blogger. Basically for dividend stock, I've always said that it's very easy to pick dividend stock because you just have to fulfill a few criteria only. The yield must not be too low or too high. So it's between 4 or 4 to 7, 470. 70 is a bit high. You don't have to be so high. You can put it at 7%, 4 to 7%. So it will instantly exclude the Eric's Parkway Life, exclude all the data centers, which are all the, in my opinion, the sucky REITs. Then it will also exclude all the US REITs, which Mr. Lu shown. Again, it's a generalization on his part. If you just exclude all this part, all his REITs they show are already instantly out already. Second, the REITs, the dividend stock needs to have profit, low debt to equity, cheap enough price to book value, PE ratio. And just by using these 5 criteria, you will instantly get most cases are 90% good REITs already. So I don't know. That's how I choose REITs. If ever I will go back to REITs. So for REITs, I would say it's like, so AK, he believes REITs, dividend stocks is good. Mr. Lu believes dividend stock is not good. But for me, I believe like each has a role to play. So for me, I would go with growth stock at the start, then dividend stock at the end, just because I need the higher growth at the start. Then at the end, by choosing dividend stock, I will avoid the estate tax altogether. Plus, I will get a stable income. So that's my plan.
I think for the lady you can be, I went to put into a compound calculator. She started at 112,000, assuming that she didn't, I don't know whether she contributed religiously over the years, but if she didn't, 1 mil to 7 within 7 years, that's a CAGR of 36.7%. That's phenomenal returns, by the way. But albeit like it's a short time frame. So unless she's able to repeatedly process out or have a framework to achieve this kind of return, I think she can actually go become a hedge fund manager. A lot of people will pay her good money to deliver this kind of returns. That's on the first point. I think on the second point, back to this discussion, right, the fundamental debate, right? I think on both sides, you see some level of survivorship bias, meaning people that done very well, they come out and say that, hey, my strategy is good. But I think on the bottom, where a lot of people pick individual stocks over the years, haven't done very well. And you don't hear much about them. Like there's no story about them because they wouldn't come out and tell you guys that, hey guys, I lost so much money, unless it's like he's a influencer and he puts his track record on the internet. If not, I think nobody will come out and say that I lost so much money and then you guys should listen to me and stuff like that. But even though I think there's still some sort of lessons to be learned there. So the second is on survivorship bias. On the same note, right, even for Mr. Lu, he keeps picking up stocks like, I don't know, Singtel, StarHub. I don't know what kind of affinity he has, but he just basically points to those kind of stocks and say that, hey, look, dividend stocks are not good because even though they give some level of dividends and returns, right, the stock price went down by so much that even the dividends not enough to cover the capital depreciation. Not appreciation, by the way, capital depreciation. So that's the second point. And I think my perspective on this whole active versus passive investing, right, which goes to my third point, really is you probably have to look at it within a range. Meaning if you do passively invest, your range or your margin of error is a lot smaller compared to somebody that actively invests. So meaning, usually, I mean, a lot of people talk about getting a 6 to 8% return, right? Let's not talk about QQQ that can give 10 to 13. So let's say S&P 500, a lot more diversified. Even though it's not the most diversified because it doesn't have international exposure in terms of like your Taiwan companies, India companies, China companies, it doesn't have that in them. So your return range are probably ranging between the 6 to 10% range. Like let's take a standard deviation of 1. So 6 to 10%, that's based on 100 years of data. But if let's say you go into actively investing, you can expand the range, meaning you can get a lot higher returns. But don't forget that your returns can also go negative, like because you can pick wrong stocks, you can have wrong analysis, you can, I don't know what some your plan should hit the fan and then you don't do as well as you think you would. So it's just you have to just think of the probability and the range of outcomes that you will accept, and then just match those different vehicles or investment strategies with your objective in life, like your financial plan, what you intend to achieve. And sometimes it might not even be financial. It might be what you want to learn from the process itself. So that's when you kind of fit everything, the puzzle piece together. And don't really have to think about like, but is there a right way to do it? I don't think there's necessarily a right way to invest. Punti?
I think sometimes, I think this debates, right, is maybe not about what investment to choose. Is it like stocks that's paying dividend or not? This is talking about the investments, right? It's more about the approach that you choose to invest your money. Say, for example, right, like even we talk about Nvidia. Actually, Nvidia is paying dividends. So technically, they are dividend stocks, right? But the approach of, like, if you study those investors that invest in Nvidia, Tesla versus those who buy REITs, right, they are very different. The approach, right, I'll give you more example in this. I think for those who invest in dividends, what they focus on is whether the company is paying dividends or not. So I think that's a dangerous thing here is because you might get lazy. And actually, this one happened to me before, because I think years before, I also invested for dividends. Like I also bought REITs, bought some other dividend stocks. And when the companies keep on paying dividends, for example, like every quarter, I just receive the money, I look at the check, like, okay, you see stable incomes, right? So I would just like be lazy and didn't study the fundamentals of the companies. And even when the fundamentals are already deteriorated, right, I didn't notice it because I'm still receiving the dividends, right? That's why I've seen quite a number of examples where companies fundamentals already become bad, but still they squeeze the companies to keep on paying the dividends so that the investors, right, like the major base of the investor, they don't realize it yet. They just want to delay the crash of the stock price, because the moment they cut the dividends, right, the share price will tank, right? So they just keep on like squeeze here and there, cut down their reinvestment, cut down their R&D, squeeze their customer, do all sorts of things just to free up some cash to pay to their customer until the moment that they cannot do it, then they say, okay, we're going to cut lah. Then that's where you see the stock price drop a lot now. So I myself experienced that before. That's why I think when it comes to like, if you really just focus on like the dividends, right, it's quite dangerous lah, because yes, like just now, I think Eric also mentioned, right, you need to know the environment. Like, for example, you invest in REITs, you need to know whether the interest rate, will it be like, stay high for a long period of time, or will it come down soon or not? You need to have some sense on macro. And then when you pick stocks, you need to have some sense on their fundamentals. And usually for people who are not, not expert in stock analysis, right, they just want to get the dividends and they just buy whichever that pay high dividends, right? So I think that makes it dangerous. It's not about the investment itself, because I'm sure that if you just filter for companies that pay dividends, right, I'm sure there are good and bad companies in there. The question is always that the investor himself is able to pick the right one or not. I think that's the hard part. And like what Chicken just mentioned, right? Like if you just go for passive, like broad-based passive, right, then you already have a diversified portfolio across sectors. Then you can like be lazy, unlike like when you are picking dividend stocks. Yeah.
Then begs the question though, if you're putting your money in the market, even with a passive approach, are you supposed to be lazy with your strategy? So meaning you just buy and forget and not look at it at all?
you can afford to if you have a balanced portfolio. By balance, not just like sector wise, right? Like if you get, let's say for example, like those who buy VWRA, like you're already exposed to the whole world, all sectors is in there already, you are already diversified, but that is still not enough. You need to diversify across asset class. So let's say you have some fixed income, you have some real estate exposure, and then you have some equities, and then with your CPF, EPF, whatever, overall it is like diversified already. Then you can be lazy, right? You can like just say, all this stock analysis is not for me, I'll just hold on to all this broad ETF. You can be lazy, but if you do stock pick and you have 30% into single companies, then you cannot be lazy, right? Yeah.
So on that note, right, if you are really, really diversified in a way where you're in real estate, alternative investment, gold, stock, bonds, then the returns that you have to be comfortable sitting on would not be as high as somebody that goes into S&P500 or QQQ. I mean, that's just a distinction that you have to accept in a way where the volatility of your portfolio will be stabilized, but your returns movement will not be large. When people are earning a lot of money, you wouldn't be earning a lot of money. And people losing a lot of money, you probably wouldn't lose a lot of money as well. So that's just part of the way which I go back to the point on financial planning again, where you need to kind of map out your own net worth trajectory, how much you earn, how much you're able to invest, and be comfortable with the fact that on that kind of broad-based diversified approach, you're probably going to earn only 4 to 6% a year. I call it steadily compounding. So that's just some numbers that is the model answer for people that are looking at this kind of approach.
For me, I feel that VWRA is actually more than enough for Singaporeans. For diversification. But if you are not okay with that, okay, for properties, like what Bunti said, it's actually a bit unattainable for Singaporeans. Okay, unless you count in your own homestay. And for the bond part, actually, we already have CPF. So in a way, we are already diversified without knowing it. Okay, so because for homes, we can actually downgrade in the future to extract the value out of it. Assuming it has any value left. Because the HDB will decay. But for CPF is also another thing. We don't know where will CPF be in the next 20 years. But it's likely that the government will keep our best interest in mind. Then so the only thing we have to be worried about is the VWRA part, the equities part, which is, in my opinion, is very diversified already. If one even more diversified, I think that there are some other ETFs, but VWRA I feel is good enough. So that is already a very good base for your the core part of your portfolio. Then the rest, you want to YOLO, like Tesla, Nvidia, Bitcoin, Ethereum, whatever. That can be the smaller part, like 20 to 30%, or maybe lower. So it depends on the risk appetite. Yeah, but this is housing, CPF plus VWRA is good enough for most people.
I think personally for me, just a final note right here, I feel like AK71 and Mr. Lu, right, they are fundamentally talking to different groups of people. So we have to kind of understand like what kind of viewers will reach to their kind of platform. Essentially, I think for Mr. Lu, because he does very broad-based finance, personal finance topic, right? So he does a catch-all because mostly they're Singaporeans. Most of them kind of heard of his name because of he's the 1M65 guy, right? So he talks mainly about CPF initially over the last 6 to 7 years when he started the movement. So when he's talking to a broad-based audience, right, I think he also probably value the idea of being diversified and because his message is out to the public. But I think for AK specifically, when you talk about dividend strategy, being able to pick good stocks and stuff like that, he catered to a much more niche audience in a way. People that actively find out what's dividend investing, people that probably know him also stock pick to a certain extent. Because if let's say you're only talking about CPF, you probably wouldn't be Googling about what is dividend strategy or wouldn't chance upon his blog post or his article or his video in the first place. So that's why their messaging might be different because they are basically talking to two different groups of people. And specifically for people that stock invest, you go and keep convincing them, hey, come back go and just buy VWRA. Why are you wasting your time? Don't buy into Tesla, don't buy into Alibaba, stuff like that, right? Why would the person listen to you? Because it's a fundamentally different group of audience. So that's why I think they're not really talking to the same type of people. But of course, you know, at the audience, right, in the viewer pool, you have cheeky people. They will tell AK, hey, you know, Mr. Lu said this, or, you know, they want just to sow some discord and to tell people that, hey, some other people are saying that your way is dangerous or you are doing it wrongly and stuff, and then want you to defend your position. But I think back to the point on what, for those of you who haven't watched AK's video, AK said that you only need to defend if you want to go and, if somebody is taking something away from you. But clearly, Mr. Lu is not taking anything away from AK. AK is going to do whatever he's doing. He's going to stay hugely invested in the banks and the REITs as well. So he don't really care about what Mr. Lu has to say anyway. So that's just people are just trying to instigate some drama, but that's that anyway. So yeah, hope you guys enjoyed the discussion. You probably still have to find your own way. Sadly, we can't help you or we can't advise you in what's the perfect way to do it. I think generally what we have been doing, we are quite transparent about how we invest and put our money. You can follow or basically take away what you think is logical and throw the rest back to us again. So hope you guys enjoyed the discussion and we'll see you in the next video. Goodbye.